Well, first of all, one has to answer the question, what are emerging markets? So many might think of the original definition of the BRIC countries, which are 4, then there are the next 11, which are 11, or there are the next 50, 60, 70. So in my world, as a development banker, we tend to speak about the entire range. So from all the way from China to Malawi. On average, the growth is higher in emerging markets than, well, as compared to Europe or the US or anywhere else. So that means also the risk is a little bit higher. The risk perception is much higher, but you need to be able to manage those risks in order to benefit from that growth. i.e., if a country grows 5, 6, 7% instead of 1 or 2 in Europe, and you are able, because you know the country, you know the environment, and you can assess the risk a bit, you're able within that country to find the sector that outgrows the country, and within that sector to find the one player, the one company that is the champion in their specific sector, then this is a very, very nice chance for institutional investors. Mobilizing institutional capital into VC or private equity in emerging markets would work through a variety of mechanisms. So one could be to think about blended finance, which is essentially bringing governmental money, or let's say money with lower return expectations, into deals, which is not necessarily the first recommendation I would give to institutional capital, because typically this money would be invested into higher risk asset classes. That's not what you look for as an institutional investor. You look for the lower risk and higher return asset classes, which are there in emerging markets. What you need to do is team up with people or with institutions, with investors who know that space in these markets. And there are a variety of those. I mean, I represent a development bank, so we do that, and we do open, like many other DFIs, development finance institutions, we open our book and our activities to the outside world, because part of our mandate is to attract commercial capital and to mobilize private capital into these markets. So just get in contact and we try to ramp something up together. Opportunities in emerging markets, when it comes to asset class, SDGs and impact themes, are various. They are multiple. So we divide our work into 3 groups or 3 themes, and each of them can be regarded both as an SDG measure or an SDG tool, as well as an asset class. So one is, for example, financial institutions. From an asset class, it's very simple. It's banks, insurances, and all that. From an SDG perspective, it's financial inclusion, access to finance, SME finance, which we can't do ourselves being a small institution in Germany. So that's one group. The next group is infrastructure, which is both, again, asset class and SDG measure for energies, for water, waste, telecom, so digital infrastructure. That's the second group. And the third one we are active in, and one should be active in, I think, is what we call industries and services. So this is this is for the basic needs of people: food security, healthcare, education, social housing, etc., etc. So all 3 again can be seen both as an asset class from an investment standpoint, and as a measure to improve or to achieve the SDGs.